Most investors get killed during a market crash, and that hurts. But what if you could walk away with more money instead? In this video, our head of options trading teaches you how. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City since 2005, and now Miami as well, and proud to develop numerous great traders. Watch, take notes, and learn from the team at our prop firm so you can grow your trading account.
Hi, I'm Seth Freudberg, and I'm the head options trader here at SMB Capital. And unless you've been hiding under a rock somewhere, I'm pretty sure you're aware that the market is in the midst of a strong sell-off since the S&P 500 reached its all-time high on February 19th, hitting 6147.43 intraday. And since then, it's been straight downhill, trading now below the 5600 level. And that's not been seen since September of 2024. So we're closing in on an official market correction, which is where the market drops 10% or more. And so there are plenty of hurting investors and traders out there, many of whom are in full panic mode and unloading stocks as quickly as they possibly can. But for an options trader, a situation like this is actually a huge opportunity. And there's a strategy that options traders employ, the modified risk reversal, which, if properly structured, can give rise to substantial profits. And the beautiful part is that even if those huge profits don't materialize, in many circumstances, at a minimum, you'll make a small profit, which is why this strategy is so often employed by professional options traders. Now, before we get into exactly how the strategy works, if you're absolutely brand new to options trading, you don't know much about how options work, we put together a video for you to understand options basics. And so you can click that video appearing on your screen right now, and it will lay out the groundwork for you to understand the option strategy that we're going to be sharing with you in this video. Then, when you're finished, you can come back and watch the rest of this video. To show you an example of how the strategy works, let's head back to a similar market situation from last year so that you'll see how it plays out. So let's head back to July 24th of 2024, where the index, after having hit its all-time high at that time, which was 5669 on July 16th, the market began to sell off strongly, such that by the end of the day on July 24th, the index had lost nearly 250 points in value, closing at 5427.13 that day. And so let's say that for whatever your reasons are, you felt that the index was oversold and you wanted to put on an options trade that would prosper if there was a bounce. So let's say that on that day you pulled up an options chain expiring about 3 months later on October 18th. And with the index trading at 5427.13, you scrolled down to the put side of the options chain and you went ahead and sold one 5400 put, 27 points below where the index is trading, for a price of 118.60. And then you went 200 points further down the chain to the 5200 put, and you bought that for a price of 71.75, creating what options traders call a put credit spread for a net price of 46.85. And then you headed up the options chain to the call side, and you found a call option with a price a little bit lower than the net credit that you received for the put credit spread trade you made, which in this case was the 57.50 call, selling for 43.85. And you went ahead and bought that call. Well, when you do this, selling a put credit spread and buying a call at the same time, you've entered into what is referred to as a modified risk reversal trade. Now, it's important to understand the cash flow implications of the trade that we just entered. So let's take a look at that for a minute. And so starting with the cash we received selling that 5400 put, you can see that we sold it for a price of 118.60. But remember, index put options pay off at a rate of $100 per point below that put strike price on the day the option expires. So you multiply that by 100, and so the total cash you'll receive for selling that put is $11,860. But then we have to pay for that protective put 200 points lower at 5,200, which using a similar calculation cost us $7,175. And of course, there's the cost of the call up at 57.50, and that cost us $4,385. So when we net it all down, the entry cash flow is actually positive in the amount of $300. And so your account's cash balance, you'll see this, will immediately increase by that amount. It's important to also understand this position is going to require $19,700 to enter in the first place, which is the trade's worst case scenario. Let's now move to the day that this trade expires, which, as you can see, was about 3 months later on October 18th. And as you can see, right after we put the trade on, the market sold off even further, and our bullish bet wasn't looking very good at that point. But then, in early August, the market started to bounce and remained quite bullish into October, closing on October 28th at 58.6467. And so now that the trade's expired, we're in a position to give a definitive final value to each of the options comprising the modified risk reversal trade. And so starting with the initial $300 we received when we first entered the trade, well, the 5,400 put we sold expired obviously way below where the index closed that day, more than 400 points below. So that put obviously expires worthless, and the same for the 5,200 put. That also expires worthless. But also, the call we bought, well, the market expired way above where that call was located at 57.50. And so that call expired in the money, meaning that the market closed above the call's strike price, and therefore the call has to pay us $100 per point above the call's strike price. And so to calculate that, you take the index closing price and subtract out the call's strike price, and in this case, that comes to 114.67. And so given that you get $100 per point above 57.50, the call option expired with a value of 11,467, which when you add that to the initial $300 in cash flow, it gives you a final trade profit of 11,767, a return of 59.7% on the initial capital requirement. Before we wrap up, I want to call your attention to a really important point about this trade, and that is that if you'll recall, the index was trading at 54.2713 when we first entered it. And you'll remember that the put we sold was the 5,400, and the put we bought was the 5,200, and we collected $300 up front. You know all that already. When you sell a put option, you're the one who has the obligation to make a payout if the index closes below the put's strike price. And so in this situation, the only option we sold is the 5,400. And therefore, that's the only option within this strategy that has a potential payout obligation. And so what that means is that if the index were to have sold off to 5,400, we still would have won $300, even though we had deployed a strategy that was supposed to take advantage of a bullish move. And that's because at or above 5,400, both puts expire worthless, and so we have no payout on the 5,400 put. In another case, if the index had just flatlined and didn't move, so it was neither bullish nor bearish, we still make $300 because, again, we didn't close below the 5,400 payout point. If the index had rallied but stopped at the call strike price of 57.50, we'd still make $300 because both puts would expire worthless, but the call would also expire worthless because there would be no payoff at or below 57.50 on the call. And the call didn't get beyond 57.50 in this scenario. And now above 57.50, of course, we'll make the $300 plus $100 per point that the index expires above that. In other words, how much the call was what options traders referred to as in the money. It's only in that one case where the index closes below 5,400 that there is any possibility of losing this trade. Although once we get below 5,400, that $300 we got up front, that's going to dissipate away pretty quickly, at which point we'll start losing money on the trade at expiration. So in most circumstances, you'll make something from this trade. It's only when you're pretty bad at calling direction and you're not wrong by a little, but you're wrong by a lot, only in that one circumstance will you lose money on this trade, even though, of course, it does best when the index rallies by enough to actually activate the call. And so what I'd like you to take away from today's video is that there's a strategy that really leverages the hell out of market crashes, and that's known as the modified risk reversal trade. And structured properly, like we shared with you in today's video, where we receive positive cash flow at the outset of the trade, we're going to win this trade in every circumstance except where we're wrong, not by a little, but by a lot as to direction. That's a pretty good situation for a trader to be in, to be able to be slightly wrong and still make money. And there are so many other option strategies that have the similar risk profile as this one, where in most circumstances you win, and that's why people get hooked on trading options once they start to understand how powerful they can be. Professional options traders are well aware of these strategies and utilize them all the time to take advantage of extreme market circumstances like the aggressive sell-off that we're experiencing today.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window. So don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.